Research reveals private equity is the best asset of the past decade, but there's an even better performer that was left off the list.
Cryptocurrency, definitely a lot of headlines recently. Performance has been absolutely stellar. Private equity, it's a very attractive asset class, as you can see by the numbers that we've pulled together.
It's Monday the 8th of April, and you're watching Markets with Madison. Markets are exciting to watch day in, day out, but most of us are investing for a much longer time period, a decade or more. Research shared with me by Mercer shows the best and worst performing assets of the past 10 years and how they've changed year on year. But remember, past performance is not always an indicator of future returns. We'll start with the worst. Commodities, comprising the likes of oil and metals such as gold, is the only asset in the negative over the past 10 years. It led the list in the year 2022, but sunk to the bottom in 23. Over the past decade, cash, bonds and debt have all had low single-digit returns. Even hedge funds haven't done much better. Globally, listed property and emerging market equities just managed 5% gains. Turning to the top of the table, listed infrastructure outperformed listed property, and Australian equities have had a solid run. New Zealand direct commercial property has made a 9% return over the past 10 years, but was still beaten by global equities when New Zealand dollar hedged, including small cap stocks. New Zealand equities are on par with unhedged global equities at 11.5%. That's despite the domestic market sinking compared to the US S&P last year. History shows that private equity is the place to be, with a near 15% return over 10 years. But an absent asset class, Bitcoin, beats them all. Its price has grown by around 20,000% in US dollar terms in the past decade. In this interview, Mercer's Chief Investment Officer explains its exclusion and why investors may have missed out on good gains elsewhere. Hey Paddy, thanks so much for coming on the show and appreciate you passing on this research.
Pleasure, Madison, and good to see you again.
Yeah, good to see you too. My first question is actually about an asset class that just isn't on this list at all. It's cryptocurrency. Why is Bitcoin, an outperforming asset class over the past 10 years, not on this periodic table?
We tend to focus on asset classes which are used by institutional investors. So asset classes which have a very long track record, highly liquid generally, and are used to create a long-term diversified portfolio. So KiwiSaver, for example, or looking after looking after money on behalf of endowments and foundations. So cryptocurrency, definitely a lot of headlines recently. Performance has been absolutely stellar, I think up 180% in the past 12 months, but also very volatile. So if you're looking at our periodic table, which looks at 16 asset classes, which are generally very well invested in across the world, or across institutional investors' portfolios, cryptocurrency would have either been the top performer or the bottom performer over every year.
The winner of 2023 was very clearly global equities. They had a stellar year in 2023, especially those magnificent 7 stocks. But do you think they're in line for another stellar year this year?
Absolutely, Madison. And I think when we caught up last year, that was the returns have been quite a surprise in terms of we were in an era where you had high inflation, high interest rates, a pretty subdued outlook for the markets. But I think markets have really looked through that, and you've seen quite surprisingly strong performance in 2023, and that's continued into 2024. But what we've really seen is that those 2023 returns for global equities have been absolutely dominated by tech and the Magnificent Seven, which has been very well debated. So if you're looking at those, the S&P 500 returns, for example, those Magnificent Seven stocks delivered 77% of the total return for the S&P 500 over 2023, which is quite staggering. And that means that the remaining 493 stocks only delivered 12% return, so half that.
Was Mercer invested in those?
Probably not enough, Madison. I think a lot of active investors were underweight the Mag 7. I think the index has outperformed active management over the last couple of years, and it's been a tough time for active management with very narrow rallies.
Given those global equities and those tech stocks you mentioned had such a good 2023, does that make it harder for them to back it up to also have a good 2024?
I think it does. I think if you look at some of the Mag 7 and some of the tech stocks, the earnings have really come up, and that has made the PE ratios elevated, but still pretty expensive. So we are actually seeing a tech bubble this time, but backed up by earnings, unlike in previous cycles. But valuations are elevated. I think we'd probably caution on valuations, and we're probably seeing better value elsewhere in the investment universe.
Yeah, this is the big question that is racking the mind of every single active investment manager that at least I know at the moment. Is Nvidia overpriced? Is it overhyped? And is all of this a tech bubble? What do you think?
Yeah, I think they're very strong companies. I think you've seen very, very strong earnings growth from these companies, and that's probably justified to some extent the rally we've seen to date. But no, we probably are seeing better valuations elsewhere in the investment universe. Some of the stocks and some of the asset classes which haven't really benefited over the last couple of years are probably looking relatively better value.
I want to talk about private equity as an asset class, and it is, according to your periodic table, the best outperforming asset class of the past decade. But investors have very little access to private equity as an asset class. So what do you think needs to change in that accessibility piece to ensure that more investors can get access to what is an outperforming asset class?
Yeah, absolutely, Madison. And I think if you're looking at some of the Australian superannuation funds, for example, so the equivalent of KiwiSaver, a lot of those funds now do have quite significant private equity investments. We're not seeing that in KiwiSavers. It's just that the KiwiSaver funds in New Zealand tend to be very focused on liquidity, and having those high allocations to illiquid assets has been a challenge for those funds to date. But if you're looking at KiwiSaver performance versus Australian superannuation performance, over the past few years, it's light and day. The Australian superannuation funds with those higher growth assets allocations, the higher asset allocations to illiquid assets have really outperformed. But I think when you're investing in private equity, it's a very attractive asset class, as you can see by the numbers that we've pulled together there. So it's outperformed significantly over 10 years, so nearly 5% above most of the equity asset classes, the listed equity asset classes. And it's really given investors opportunity to invest into early stage technology, into the artificial intelligence thematic, but other thematics as well, such as the energy transition, demographic change, and so on. So it really has had a lot of tailwinds in terms of what investors have been able to invest into. But as you say, for a standalone retail investor, it's pretty difficult to access. And our advice would really be with private equity, you want a diversified approach. You want to be invested across different vintages and across different thematics, across different managers. It's going to remain a challenge, unfortunately, to have an institutional grade investment for the retail investor. But we're working on that and democratising access to private equity.
One thing that I always find really interesting about this data that you hand over, Paddy, is how much these asset class performances can change year to year. If you take commodities, for example, they were the best performing asset in 2022, then were the worst performing with actually a negative return in the year 2023. And I think New Zealand equities tells a pretty similar story here. It had a pretty average year last year, but over the past 10 years, New Zealand equities have actually performed quite well. They're about third on the 10-year timeline. What do you think is going to happen with New Zealand equities from here? Should we stay in them?
Yeah, absolutely, Madison. And it is quite intriguing, isn't it? If you look back at the periodic table, New Zealand equities was one of the top performing asset classes in the world, 2014, 2015, right through to 2020. And the recent returns have actually really been disappointing. And I think, in fact, the returns have been flat, or the equity NZX level is roughly where it was pre-pandemic now, which is unlike other asset classes or other equity markets globally, which have now been testing all-time highs. So some of the challenges with the New Zealand equity markets, it's not widely held by foreign investors. So for example, something I like to pull out as an anecdote is that Apple and Microsoft, the two largest companies in the world, individually, they're 25 times the whole New Zealand equity market capitalisation. So New Zealand's pretty insignificant for global investors, and we're not attracting a lot of global capital into the New Zealand equity market at the moment. At the same time, with interest rates having increased, a lot of New Zealand investors have been looking at better returns from or lower risk income from government bonds and credit. So, we think New Zealand equities are a lot better valued than they were. The valuations did get pretty high. They're very defensive, and they pay relatively high dividends compared to other markets around the world. So, we think they'll have their time in the sun again, albeit maybe not the top performing equity market in the world for an extended period.
All right, most important question, Paddy. This tells us how assets have performed for the past 10 years. But what's going to happen in the next 10 years? Where should we be invested for that?
Yeah, over a 10-year horizon, we think growth assets generally, for those investors who can really lock up their money for a considerable period of time, aren't worried about volatility in their investments, sticking with growth assets really is a place to be. So in private equity, if you get access to it, well-diversified equities, be that global equities. We like emerging markets. Currently, we think the valuations probably haven't been as stretched as they have in other markets. Listed property as well has been pretty beaten up, so we think there's some pretty good relative value there in the short term. But at the growth end of the allocation is probably where you want to be over a 10-year horizon, and that's exactly what we've seen over the past 10 years. Those growth assets have significantly outperformed the more conservative options. So if you've got a long-term horizon, don't leave your money in the bank.
I'm going to call it the growth game. Thank you so much for your time, Paddy. Appreciate it.
Great. Thanks, Madison.
Mercer missed out on some of those gains, but maybe you didn't. I want to know what asset classes you're backing for the next decade. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald's show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below, and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.